So I've been doing this podcast for just over 3 years and I really want to bring it live for you all. So I'm going to need a favor from you. If you're interested in seeing the Savvy Wallet podcast live, please register your interest by signing up to my mailing list with the link in the description of this episode. Thank you so much for your support so far.
And I think as a financial services industry, we've failed a lot of people by not having access to this information. As financial advice firms and financial services firms, we gatekeep a lot of that information. That's a big reason why there's a wealth gap. There's a big reason why kind of there's a massive gap between women investing and men investing and kind of building for the financial future.
That is the truth. It wasn't like we were told, okay, this is how you budget, this is how you save, this is how you invest, and this is what your investments can grow to. This is how you put money into a pension. You was just like left to fend for yourself, really.
Yeah. People are obsessed with that £1 million pension. I can't retire until I've got £1 million pension. It's not that. It's figuring out like what you need to be able to have the life that you want and then building a plan around that.
Yeah. In terms of overpaying mortgage versus investing, does it make sense to overpay your mortgage or invest that money instead?
We're conditioned to think like bricks and mortar are the safe option. Like we've got this obsession with getting on the property ladder within the UK. Again, people say, oh, well, my pension is my house. So you telling me you get a retirement in that house that you've grown up with your kids and your grandkids and all these memories, you're suddenly going to downsize the 4-bedroom house and go to a little 1-bedroom flat. And a lot of people say they're going to do it and a lot of them don't.
Is there ever an age where it's truly too late to begin investing?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people.
Like you have to be able to be uncomfortable.
Yeah.
Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Ian, who's an independent financial advisor with nearly 20 years in the financial services industry. Ian, how are you doing today?
I'm good, thanks.
Welcome. I'm looking forward to this conversation. I think it's going to be a very, very interesting conversation. How's your day been?
Full on.
Yeah?
Yeah. Like a busy day. And obviously Newcastle won the cup yesterday, as we said it's the first time in 70 years. That was a big day in my house.
Yeah. So what do you do to celebrate?
I was out with my son. Like my son's a Newcastle fan as well. Okay. One of them is. The other one's an Arsenal fan. So he's going to be...
Yeah, that's good man.
Come on. So, we watched the football, just had a few beers. It was like, it still doesn't feel real.
Yeah.
Still doesn't feel real.
Yeah.
Like honestly made my day, like over the moon with it. And then just... straight back into it today.
Yeah.
There's been like have some client meetings and stuff to do, a little bit of marketing. Like when you run your own business, you've got to have all the hats on.
There's a lot going on, right? Yeah, like it's always like something else because essentially, right? If you like business is such an interesting thing. If you don't really move the needles, like no one's gonna move it for you. You kind of got to just kind of do it yourself, right?
On you, all of it. Yeah.
But it'll be interesting to hear a little bit about that. So, for those who may not be familiar with you, can you share a bit about your background and what inspired you to become a independent financial advisor and how you kind of, took steps in it?
Yeah. Never ever wanted to be a financial advisor. Okay. So my dad was a financial advisor in Newcastle. My mum worked in banking. And I kind of never go to the offices. I'll be like, this is boring. Like filing cabinets in grey suits and everything stunk of coffee and cigarettes. And I'm like, nah, not me. And ended up just working in sales. And then got an opportunity to kind of, when Jack was born, my youngest one, we were going to move to Newcastle and kind of resettle up there. Didn't work out. I came back down, took a job in financial services, really enjoyed it. Enjoyed dealing with people and then just took some mortgage qualifications, enjoyed that. Worked as a mortgage advisor in the banking space. And so these guys that came in at 10 o'clock, had a nice car, had a nice suit, had a nice watch, left at 4. And I'm like, who are these guys? And they're like, they're the financial advisors. And I'm like, started having a chat with a couple of them. I'm like, what do you do? How much money do you earn? All that kind of stuff. And they were, like for me, that was me hooked. And I just really wanted to do it, but wanted to do it on my own. Eventually, because like the whole corporate space, it was great for the training, great for the structure, but I just felt like a little bit of a square peg in a round hole and just felt like I had to do it on my own and jumped in with both feet at the start of lockdown.
Yeah. And how does, doing it on your own, how does that kind of differ to doing it like in the corporate space? Like what kind of, obviously it sounds like you're a bit more freer, but like how does it kind of benefit you doing that?
Initially, I was crushed.
Okay.
Like on day one, bear in mind that on day one, I'd already been doing the job for like 15 years or so. I sat at my desk and I didn't know what to do.
Okay.
Like genuinely, I sat down and I'm like, right, I need to have an accountant. I need to have a bank account set up. I need to do this. I need to think about my market. And I need to think about all. And in my head just like went into a massive spin.
Yeah.
And I kind of had to go and take a walk, clear my head and come back and sit down. Like, I've been doing the job for 15 years. I can do the financial advice. It's the other stuff I've got to learn. And it was trying to figure out what that looks like. And like the whole social media game, especially in financial services, is still relatively new. And there's not a lot of regulated guys that are doing this and doing it properly and doing it well and building an audience. So it's still untapped.
Yeah.
And I just jumped in with both feet and just...
So it was not like a blueprint for you to, or somebody could have reached out to be like, oh, can you kind of help me out with it?
And there wasn't, and that was the great thing about it. It was brand new. And there's a lot of people do it now. Yeah. But it's still a very, very small percentage of the industry that kind of use social media. And it's such a powerful tool for good. And I think more advisors should be doing it. And this whole creative space in financial services is a hell of, well, that's how we met. Like at a financial at one of an event. And like what amazed me about that event that we all went to was just how open everybody was.
Yeah, exactly.
Talking about like, oh, what are you working on? And what's this? And how do you do that? And how do you do the other? And like, oh, what's your platform? Oh, I do this. And you're like, you wouldn't get like 20 financial advisors doing that. Like, no, you wouldn't. Not at all. Like, you got these conferences and it would be like, I make 300 grand a year and how much do you make? And this, that, and the other. And obviously I'm kind of, that's the extremes of it. But like, I didn't want to be a part of that world, you know? And then the whole creative space, and I'm like, ooh.
So you feel like this is more, it's like more, because obviously I guess there's a lot of different financial advisors, but you may be a little bit too, is it not formal? Is formal the word?
Yeah.
Too just
stuffy as well. I'd put it as it is. Like,
stuffy.
It is, absolutely. Of course it is. Like, and there's this impression of financial advice and financial advisors, and years and years ago, I was working with an accountant, and he kind of, when he got into accountancy, someone who had mentored him said to him, what kind of accountant do you want to be? And for me, I kind of thought, well, what kind of financial advisor do I want to be? And it got to a point where I'm like, I want to be the financial advisor that's not like every other financial advisor.
Yeah.
And there was a guy on LinkedIn, an American guy, did a post this week on LinkedIn. He said, I could put 100 financial advisors in a room and every single one of you would insist that you're different, but 99 of you are exactly the same. And it's true. Like, you know, it's so prescriptive, like the process that you go through with clients. And it's like, I don't get excited about pensions. Like, how am I supposed to get my client excited about pensions when I'm like, what do you want to do for the rest of your life? And fill this form in and, tax relief. Like, it's boring, man. But like, the whole thing for me was like dealing with people and uncovering well, actually, what do you want to do with your life? Tell me about that. Like, why is that important to you? Yeah.
So the mindset and the actual goals behind what you're trying to do, because money is like, it can be a thing, or it can be used for you living out your dreams or your life and stuff like that. So it sounds like for you were more focused on actually what's the motive for a lot of why you want to do what you kind of want to do, right?
And that was really deliberate, because I think I got to a crossroads in my career, and it was either I do the chartered qualifications and go down that route, which I'll probably do at some point, or and that would have been maybe become a really technical advisor, or do I concentrate on the behavioural side of stuff? And it was the behavioural side of it, like coaching. I'm not qualified as a coach. It was using other coaches to kind of uncover like how to have better meetings with the client and how to kind of have a better process and how to make the client onboarding side of things really slick and smooth, and all of that stuff. And I just absorbed myself in it. Yeah. And it was fascinating. Yeah. And interestingly, like, you can tell a client financial advice, but are they going to follow it through?
Depends on how,
and that's the hard bit, because a lot of people will kind of think, well, yeah, do you know, I know I need to put £250 a month into a pension, but if you say, I thought you need to put £250 a month into your pension, you'd be like, I'm not going to use that. I'm 65. That's a long way off. Do you know what I mean? But if you're kind of saying, right, Atto, like, what do you want your retirement to look like? And if it's the villa in Spain, and it's like, imagine that, feel it, and get into the emotional side of it. That's where the power is. It's not the numbers on the page.
It's true. It's true. So it's like putting something that's tangible and, that aligns with you, and that is like close to you, who you are in your heart and stuff like that, is what will kind of get you motivated, which is true. Yeah, that's a good point. And actually, we're going to talk a bit about behavioral science, because I think that's going to be very interesting, how people can kind of use it to motivate them to achieve their goals. Because you're right. Like, I think when it comes to money, we're comfortable with it. We're for us, if we say we're going to do something without thinking about it. But the everyday person may not, because it's like there's loads of things, fear, they might find it boring, and, you know, things like that. So, you know, obviously you had a lot of insights as well, you know, working in the industry, right? So, you know, based on your experience as a financial advisor, what key insights have you gained about money and wealth?
It's not a number. And I think we get so focused on those numbers of, like, what is wealthy? What's rich? And there's so much misinformation out there. Like, and you'd have seen this. Like, people are obsessed with that £1 million pension. I can't retire until I've got £1 million pension. When the reality of it is, that's absolute bullshit. And it's not that. It's figuring out, like, what you need to be able to have the life that you want, and then building a plan around that. Yeah. And that is so powerful compared to the just, I think I'm going to need £1 million. Just doesn't, like, and even now there's so many people obsessed with it. And the more kind of social media channels that I do and dip into, like TikTok has been wild, because it's like, I started on LinkedIn and doing it on there. And there's an assumed level of knowledge, right? Or maybe people aren't as confident to kind of publicly kind of put the questions out there that they may think are maybe a silly question. And there isn't such a thing as a silly question with this stuff. But, like, you get on a TikTok and you see the real world. And so many people just don't understand this stuff. Yeah. And I think as a financial services industry, we've failed a lot of people by not having access to this information. And that's why social media is such a powerful thing. And it needs to get better. And that's why this creator space exists. Because as financial advice firms and financial services firms, we gatekeep a lot of that information. And if you want to find out what kind of pension you want and what that's going to do for you, all right, mate, there's a bill for $3,500.
Definitely.
Do you know what I mean?
That is definitely what it is.
And there's nothing wrong with that, right? Because actually, for the right person, I think financial advice is incredibly important.
100%, yeah.
And it really, really works if you get the right advice. But we've gatekept that information for so long. That's a big reason why there's a wealth gap. There's a big reason why kind of there's a massive gap between women investing and men investing and kind of building for the financial future. When I kind of cut my teeth in the banking space, there was, I think it was about 200,000 financial advisors in the UK. Wow. Might have even been less. I can't remember the exact number. Now there's something like 23,000 active with a license to give financial advice. That doesn't mean they're all active. Like, that market shrunk massively. And there's not enough people coming at the bottom end to be able to do that. Yeah. And a lot of the big corporates kind of almost control that space, which is fair enough. That's how they've kind of built the brand and all the rest of it. But like, I'm really interested to see how that evolves. Like, the average age of an advisor is something like 58. Like, would you go and sit down with a 58-year-old and get financial advice? Would you?
Don't put me on the spot, man, because I've had people, you know, that are older, and I don't discriminate.
No, but, all right. Sorry.
But I'm an interesting person, because I speak to a lot of people, and so I'm not your everyday person, but I can see how an everyday person may not think that's relatable for them, for sure, because maybe they don't think that they understand what they're going through or what their situation. And they do say that, right? Like, the generation before you, sometimes they don't sometimes get along or understand each other at times. So yeah, no, I do understand what you're saying. That's so interesting. The gatekeeping thing is so funny, because that is the truth. That is why this creator space existed. I mean, when I started, obviously, Savvy Wallet 5 years ago, but prior to that, I did want to start my own blog. And the only person really doing anything, and I wouldn't even say it's like crazy personal finance, was only Martin Lewis. He was the only one sharing free information that was known. I don't know if there was other places. I guess Motley Fool was like maybe doing investing, but to me, that was quite niche. But you're right. It wasn't like being... like, we were told, okay, this is how you budget, this is how you save, this is how you kind of invest, and this is what your investments can grow to. This is how you kind of put money into your pension. You kind of was just like left to fend for yourself, really. Yeah.
And you're conditioned that's rude to talk about money. Yeah. You know, like, don't talk about money. Like, my parents worked in financial services and we never talked about money. Ever. Yeah. Like, I came out, like, when I left home and kind of moved down south to go to university, my finances were in a state. Yeah. because I didn't know how to budget, didn't know what a credit card was, didn't know credit score, any of that stuff, and got in a right old mess.
Yeah.
And sadly, that's how a lot of people learn.
A lot of people, yeah.
And actually, there's a big kind of swathe of stuff kind of happening in the background, and that financial education piece and just explaining even fundamentals of finance to people makes such a difference.
It does, yeah. Just the basics, right? Like even, this is something I'm even battling, right? Not me personally, but that I've just now, it's like someone I kind of known is now come to the forefront, a young person, right? Buy now, pay later. That wasn't a problem for me at a younger age. It was a student loan error, right? Not student loan error, sorry, student overdraft error, right? That's how they were kind of catch you. Now their error is probably still a student loan overdraft. Sorry, student overdraft. I keep on calling it loan. Student overdraft. But now the buy now, pay later. So even if you have no money, they're able to buy clothes.
Yeah, like a pair of jeans, money, man. It's crazy.
Yeah. So I didn't have that when I was younger. I had to have, the only money I could get was at least get an overdraft, and they'll give you at least with the facilities, they don't give you any more than 1,000. So if you did, okay, 1,000's not good, interest free, whatever. But now it's like buy now, pay later. It's not even like a credit card where like you have to, fill in an application form, wait 21 days or whatever for it to get it, pass a credit check. Now they're just able to kind of do it, right? So that generation even needs the financial literacy even more than our generation, which is crazy.
And you'll get sucked into that.
Yeah.
And these are big, powerful marketing machines behind this.
Yeah.
Like when you go through your purchases and you put your details in at the end, it'll be like, oh, do you want this on interest free? And do you want this or do you want that? Like my older son kind of got sucked into it.
Yeah.
And he was about to buy a hoodie or something for like, and it wasn't even expensive one, like say 60 or 70 quid. Yeah. He's like, oh, I'm just going to put it on buy now. And I'm like, no, you're not, son.
Yeah.
And I was like, this is how it works and this is how he gets sucked into it.
Yeah.
And that's a challenge for him to kind of learn his way around it, you know what I mean? And he's putting resistance back as well, because he's like, as kids kind of push back against their parents, you know what I mean? Yeah. And they're like, oh, Dad, you're old, you don't understand this stuff. But I'm like, listen, I've been around this space, I know the money, and I've made every mistake that you possibly can. And that's why it's sometimes difficult to relate to financial advisors, because a lot of financial advisors haven't necessarily made those mistakes. They've done everything right over a period of time, or supposedly right.
Yeah.
And a lot of them, like some of the financial advisors I've worked with over the years, have been in a right old state, and mine have as well. You just put a brave face on, kind of like, and I felt like a massive hypocrite at times.
Yeah.
Do this, do that, do the other, and I'm not doing any of it.
I get what you mean, yeah.
And it's like I'm putting stuff on a credit card just to get by every month, like. And that's what kind of really got me.
More real and authentic and relatable. It makes you more relatable because you can kind of understand where people are kind of going through when you've kind of gone through that kind of situation. But yeah, the buy now, pay later is a problem. I knew it was a problem, but I kind of maybe didn't think that until I kind of heard this as like, oh my God, like this is actually like a problem. Now you're buying stuff with money you don't have, and your credit score is going to be bad because because of a £30 clothes or £50 t-shirt or whatever.
Yeah.
And I know young people, they want to impress, especially with social media, they want to do like all that sort of stuff. So yeah, it's such an interesting thing. Picture this. You just delivered outstanding results for a client and they ask you to provide your services or products for free. You say no, right? And for good reason. Your time, skills, and effort are valuable. But when you leave your business funds sitting in a regular current account, you're essentially doing the same thing, missing out on potential earnings that could help cover essential business expenses like taxes, staff wages, software subscriptions, and unexpected costs. That's exactly why I use Tide's instant savings account, where I passively earn 3.81% AER Variable on my business savings without doing any extra work. Plus, I can access my funds instantly anytime I need them with no withdrawal fees. And I get FSCS protection on up to £85,000. My savings stay secure while they grow. We're teaming up with Tide for this episode, and they've got an exclusive offer for new members. Sign up with my code SavvyWalletQ1 and get a £100 bonus when you open and fund a Tide instant savings account with £5,000 within the first 30 days. Opening a Tide instant savings account is quick and easy. It takes just 4 simple steps. To claim your £100 bonus, tap the link in the episode description and enter the code SavvyWalletQ1 when signing up. Boosted offer valid until the 1st of June 2025 for new customers only. Rate correct as of the 6th of February 2025. Visit tide.co/savings for up-to-date rates and full terms during and after the promotion. So as well, right? So you've worked with clients across like, different wealth levels. I guess what were some of the most common paths that they kind of did to, accumulate their wealth? Was it through like 9 to 5? Was it like a business? Was it through investing? Tough question.
That's
right?
a good. Well, it's a great question, mate. Because actually, I think like a lot of the most successful people I've ever worked with were business owners.
Yeah, that's what I keep on hearing.
A lot of them, and you're talking like probably 90% of them. Like to the point now, if I'm trying to remember all the clients I've worked with over the years, there's probably only 1 or 2 that were employed.
Okay.
At that serious level of wealth,
like CEO and stuff like that of a company,
and because they've got that level of control, and they can just see the value in it. Like I love working with business owners simply because actually they want it done. They want it done quickly. They want it done properly, and they want it done right the first time. And I think that's an incredibly powerful space, and they see the value in what that financial advice and that support is going to give them.
Yeah.
And if you get that advice piece right for somebody in that space, makes a massive difference. Saves them tax, makes them more tax efficient, puts money aside, gets money out of the business into their name, all that great stuff.
Okay, I understand. Yeah.
But if I'm kind of like everybody in the whole space, even the unemployed space, we should start a tuning. Everybody says it. I wish I'd started tuning. I wish I'd just took the pension when I was 20, took the stocks and shares ISA out, even put 10 or 15 pound a month in, and just let compound growth do the heavy lifting.
Yeah.
That's what you need to do.
Yeah.
And the most successful people I've worked with as well as having the business started that.
And
And
started it earlier.
Yeah.
Okay.
Started early, keep putting in, because it gets to a point where it just starts to turn. And life's expensive, right? Like if you go through the standard cycles of like, come out of school, maybe you go to university, or maybe you just go straight into work, then you settle down, you have kids, kids are expensive, then you kind of get your 30s and your 40s, and you're like, I need to take it seriously now because I'm going to be 60 soon, and I need to start thinking about what our future looks like. But sometimes you've really got to play catch up then. Like I'm talking to my kids now and I'm like, start a pension, put the money in, talk about budget. I get 2 of my boys to kind of do some of the social media editing, and they're soaking it all up like a sponge. And I'm like, what's an emergency fund for? And they go bang, 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 bang.
That's what you want.
And they're going to remember that for the rest of their life, you know?
Exactly. And they know about it. That's the difference, right? Like for me, like I said, when I was kind of coming out of uni, I was ignorant to a lot of this stuff. Like I didn't know, okay, you need an emergency fund. Okay, you need to be better at budget. Okay, you need to invest in the stock market and, in something like a global index fund or ETF. I didn't know any of this kind of stuff. So the fact that you're sharing that with your son is so amazing. The business owner thing, I've heard this consistently, right? And it's so interesting, the fact that you say not only are they've accumulated a lot of their wealth as business owners, but they've made use of a financial advisor to make them, like you mentioned, things like tax efficient, helping them set up all these kind of things, which is so interesting because it's not only are they making more money, they're being so much more efficient with maybe keeping as much of their money as possible, right?
Yeah.
And kind of figuring all of that out, which is interesting. Okay, this is going to be a harder question. What kind of areas of business were they kind of in? Were they like small, and also were they kind of like small business owners, like 1-2 man ones, or was it like ones that are bigger? Exactly.
Like right across the board.
Yeah. Okay.
Like even the ones that run like really big businesses now, and by big businesses normally there's lots of different assets in it. It's like they've got property, they've got rentals, they've got stuff that they flip. And I always kind of use the analogy for it's legs on a stool, right? And the more legs you've got on that stool, the more stable it is. And they know that. They know they've got the business, they know they've got the property, they know they've got the pensions, investments, savings, whatever else they've got as well.
Yeah.
They've got all that stuff in place. And I think even the guys that have started off relatively small, like one of my biggest clients started off with a corner shop.
Okay.
Got a corner shop. Him and his wife, when they were in their 20s, they started with a corner shop, and then they bought the flat above, and then they bought the flat above that, and then they got another shop, and it just like the accumulation of wealth you can get in that space is much, much quicker than if you're in an employed position. And I remember a client a long time ago said to me, he said, "You're never going to get rich lying in someone else's pocket." The employed space is you're effectively doing that for somebody else. That's not a bad thing because there are lots of people that need that structure and will be employed. But like side hustle culture, like that's a relatively new thing. Like you can dip your toes in the water and see if you like it, and if you don't like it, at least you've tried it.
Yeah, true.
And it's not for everyone, right?
Yeah,
it's hard, man. Like you
very hard. Yeah,
like it's one of the hardest things I've ever done is setting up a business and running it. And I see clients struggle almost daily, but then I'm like, would I go back to being employed? No, I wouldn't.
Yeah, I really appreciate that. And it also like talks about like even that is like, it's like steady accumulation. It wasn't like overnight or like, you know, within 6 months. It's like you said, that particular client bought the corner shop, then they bought another property. Then it wasn't like they did everything at once, right? Which is kind of, it's nice to hear that kind of aspect, because that's what you kind of want to know. It's not always like the rags to riches overnight, because that's what a lot of people think it can be. What about challenges? Did any of them kind of face any kind of significant challenges, and how did they kind of overcome those?
Oh man, like lots of them, like almost daily. Like you run a business, there's always going to be challenges. There's always going to be things that you'll find difficult, and some businesses fail, and some of them will have lost businesses that have tried other things and they'll fail. Like there's a big kind of amount of pressure that everything that you do has got to be successful. And if you're not driving a Lambo and you're wearing Louis Vuitton shoes, then you're a failure. And social media's got a big part to play in that, because young people see that and be like, well, I'll just be a YouTube creator and I'll make 5 million quid a month. Well, actually, what you don't see is the reps these guys are put in to get to that level. You know what I mean? And like a lot of them have made like all kinds of mistakes, like bought the wrong properties. They've kind of invested in the wrong businesses. But you've got to learn from that as quickly as you possibly can. And when you're self-employed and running your own business, you've got to do that quickly. If your business fails, you've got no money coming in, and you're on that breadline tomorrow. Like unless you've got assets behind you, or you're going to adapt and change quick, like where's that money coming from? How are you paying bills? How are you putting food on the table? How are you going to make sure your kids have got a packed lunch and school shoes every September? All that kind of stuff. Yeah,
it's like high risk, high reward, right? Like yes, the upside is that you can build and accumulate wealth quicker. But then, like you say, like if things don't go well, you could pretty much lose it all. And you know what you're gonna do. You have to pivot into something else, or do a new business, or maybe go back and get a job. Which there's nothing wrong with that. Like you know, so but it's interesting, right? I think people need to know both sides of it, because it's very, very like important. So we wanted to talk a little bit about the proposed ISA changes, should I say, right? So there's been some rumours that the Labour government are looking to make some, you know, ISA changes. What are these proposed changes that they're looking to make?
So they're going to limit the amount that you can put into a cash ISA is the alleged, and I'm going to say rumour at this point, because I don't think it's any stronger than that, but like it's no smoke without fire, right? And it would limit the amount they can put into a cash ISA to £4,000 rather than the traditional limit of 20k. And my personal opinion on it is that is an absolute disaster.
Okay.
Because I think just by reducing the ISA limit to £4,000, all of a sudden you're not just going to wake up and be like, oh, I'm going to start investing and I'm going to put my money into this and put my money into that. And if you look at like kind of the reasons behind the government want to do this, it's to get people to invest in, give them better education and to invest in UK businesses. The reality of it is most of the best returns aren't in the UK. Like when you look at index funds, like everyone talks about the S&P 500, average returns of nearly 10% a year, or you could put it in the FTSE, which is average of like 5 to 6% a year. Which one are you going to pick?
The US, yeah.
The education has to come with that, right? Like if they're gonna reduce it to £4,000 to encourage people to invest in stocks and shares, there needs to be some education around that. Of let's talk about what an investment is. Let's talk about what a fund is. Why is investing important? And actually, the other thing is, if you've got a pension, you're already an investor. Like, what kind of funds are you investing in within that pension? The education has to come.
100%.
And if the education doesn't come, it's just another... It's a strange policy, if I'm being honest with you. Like, I don't see how it's going to encourage people to invest.
I mean, it wouldn't, because people are not investing already, and we have this here. And if... The way I see it, right... The people who are investing in it know how powerful it is, and they wouldn't otherwise do it. Invest in anything, put their money in anything else, right? There's a reason why if you're able to max out your stocks and shares ISA, you're gonna do it, right? That it just does. There's nothing's beating it. But if you're not already doing that, then you know limiting people to 4,000 is not gonna change it. Like you say, it's not going to spark it without the education, because that fear of investing in the stock market is still going to be there. People still think it's a scam. I've said this a few times on the podcast. I had one of my episodes, so somebody reposted it on TikTok, and that repost went viral. Had like 150,000 likes or something crazy like that, like almost 1 million views, right? You should have seen all the comments. All the comments are, so how do I invest? Is it an investing scam? I was just like, oh my God, like, cause sometimes when you do the podcast, sometimes you get maybe in a bubble, because obviously a lot of people that are listening are interested in it, but then then you forget, actually, majority of people don't understand this stuff. They think it's, I'll never do this kind of thing. So it's interesting that they're not, I don't know if they've thought about the education piece. I haven't heard anything or seen anything around that.
It's got to come. Like, it has to come. Yeah. And it can be done relatively easily, right? Like, look at how powerful social media is. Like, look at that event that we went to, right? Yeah. If you got everybody in that room on the same page, we're going to talk about financial education. This is the format that we're going to follow. This is the stuff we're all going to get you to put out. Yeah. And we want to educate the nation. Like, the combined reach of everybody in that room at that event is insane. Like, if we all sung from the same hymn sheet, that can make a massive difference. A lot of us all sing from the same hymn sheet anyway, to educate people about this stuff. Like, that could fix it. Yeah. It's not taking it from 20k to 4k. It just doesn't happen, because actually the people that will invest in the cash ISA are probably the people that need that cash or want that security available to them. The other thing to think about is, if there's lots of people already posting about this stuff. There's ways around it. You could put that money in cash on an investment platform, but you'll be paying investment fees for the privilege of doing that. So actually, people that really want to invest in cash will do it through an investment platform. The investment platforms will be aware of this, and they'll offer those rates, encourage people to do that. But they'll be charging a fee for doing it. Yeah. Whereas you could have it at a bank that aren't going to really charge you a fee, like that. It's that. I don't think that's a good move, and people will start doing that.
It's like, it opens like a kind of worms. Who else do you think it will kind of impact? Obviously, it will impact most of the cash people that used to putting their money in cash ISAs. What other kind of people do you think it could kind of impact?
Well, like, cash is important, right? Everybody's got to have some cash. You've got to have like the emergency fund. You've got to have if something happens, you need that money to fall back on. I think, like, we're gradually moving towards a cashless society, and I think it affects the most vulnerable people, because actually, like, the most vulnerable people, and there are still people out there that probably don't operate a bank account, that don't have a savings account, that don't understand the fundamentals of finance. They're the ones that are going to get hit. It's not like we said, there's someone with 20 grand spare every year. Like, 20 grand's a big chunk of money. It's not going to affect those. It's going to affect the most vulnerable ones. And it all comes back to the education thing, doesn't it?
Yeah. It would be interesting to see if they do. And I know that is, so by the way, people, we're recording this before the spring budget. So I've read it's unlikely, if they were going to make this, is going to be spring budget. Potentially, if they were, it's going to be autumn budget. I still don't really get the rationale, because if you want people to invest, anyway, I'll ask you that in a minute. I just think that there's other ways, right? So let's say that Labour does implement these ISA changes. I guess, how would you guide your clients through them, and what strategies would you kind of, let me not say recommend, but what strategies would you kind of discuss with them to, try and like maximize the ISA benefits?
Yeah, I mean, most clients that I kind of look after do that already, or they're just getting started on that journey. It's about having a consistent approach. It's using that allowance if you can do it. There are lots of different ways of doing it. Your cash, your stocks and shares, your lifetime ISA. There's lots of ways to do it. And I think it always boils down to taking the numbers away and the vehicles first, figuring out what you want out of life, figure out why it's important to you, figure out how you're going to get there, figure out what could get in the way. Yeah. And that's the foundation that I talk to every client about. It's the financial coaching, the behavioural stuff. Figure that stuff out. Yeah. And then the numbers can just be plugged in. Yeah. And I think anybody that is listening to this that wants to get started with their finances, start with the goal. Start with the goal in mind. Like, what do you want to do? Is it you want to retire in Spain? Is it you want to have 15 cars in your drive, 55 property, whatever it might be? Start with that and really visualize it and get really powerful at it. Write it down. I'm a big fan of the phrase "think with ink." Write that stuff down. It hits differently than on a screen. Yeah. That's where you should be starting with this stuff.
Yeah. And I like the fact that you say, like, think about those things first, because the numbers can come later, because it's true. No matter if it changes from 20,000 to 4,000, whatever, right? You just kind of have to kind of deal with what it is and make sure that it's kind of aligned to your goal. Like you're saying, it's quite important. I guess, you know, is there anything people can do to prepare for this? I mean, it's weird because nobody knows if this is going to happen. This is what's weird about it. But it could come, and it could come in as if I doubt it'll be effective immediately. That would be bad. But I guess they'll probably say that maybe next tax year. But I guess, is there anything that people can kind of do? It's a tough one, to be fair.
Educate yourself.
Yeah.
If it does happen and you're sat on a whacking great lump of cash that you want to start putting into your cash ISAs and you're going to be limited to $4,000 you can put in, educate yourself. Educate yourself about investments. Figure out what they are, how they work, and all the rest of it. And it can be fairly simple. Like we talked earlier about index funds. That could be your starting point. But also educate yourself on what other options are available for your cash as well.
Yeah.
Because it might be that you don't do the ISA. It might be that you look at something like premium bonds. It might be that you're putting it into different savings accounts. It might be that you're looking at cash platforms, for example. It could be you hold that as on an investment platform as cash.
Yeah.
Find out what your options are, what's available to you. But I think the important thing is, if you are going to think about investing, you need to think long term. Like, you've got to be in this for the long haul, and that is like 5 years plus is the standard term that we use. Yeah. So if you're going to invest, like, don't put your money into an investment that you're going to have access to in 12 months time. Because like in 12-month window, that volatility is like up and down like that. Look at like the last few weeks.
It's been crazy.
It's been nuts.
Very crazy.
And
I'm loving it as an investor.
Yeah, man. Opportunity, isn't it? This stuff's on sale right now.
Yeah.
And if you're kind of putting that money in consistently, you're getting a better price all the time. But if you were going to buy a house tomorrow, and markets have just dropped 20% and all your money's in investment,
pretty angry.
You ain't buying a house. Or you're going to have to find some borrowing to cover it. That's why you need to kind of make sure you've got the emergency fund, your short term and your medium term, like under 5 years as the buffer. And then anything beyond that, 5 years plus, that's the bit you should maybe consider about investing. Yeah.
And you know what's interesting, right, as well? If they do this, pension is something. So this is a tough one because I'm not trying to get you to give it back. I just want to discuss around.
Just spit it out, man. Come on.
So would you, like, if this was to happen, right, would you recommend any kind of pension adjustments to pension contributions and stuff like that, or other, retirement planning stuff at that point? Or, other retirement planning strategies?
I would get a financial plan.
Yeah.
Figure out a financial plan and sit down with a financial advisor that will build you a financial plan, not necessarily the product at the end, which is the advice. Figure it all out in a plan.
Yeah.
Because I think that whole plan would then sit down and work out how much money you're going to need for the rest of your life, how much tax are you going to pay, what kind of returns you need to generate to be able to do that, and that's the important thing, and what you need to put away today, tomorrow, and everything moving forward. Factoring in market crashes, factoring in things like inflation, because that is really, really powerful, and it's all mapped out and you've got the structure. And if you want to go and do it yourself, you can go and implement it yourself. If you want them to implement it, they can do that for you. The planning side of things is going to be more and more important, especially if changes like this come in.
Yeah. This is going to be very interesting because I feel like I could see people being like, you know what, okay, if this is happening, maybe actually putting into pension. But what you're saying is true, is the education, because even if without that education, it's unlikely you could even think, let me take advantage of pensions now. And, the fact that it's tax efficient. If you're not educated, you wouldn't do that, because even when pensions are happening, I did not know that kind of stuff. All this tax efficiency, I didn't. I have to be honest, right?
Yeah, same.
You just thought that pension was something that you have for retirement, and that's it. You kind of lump that and state pension in the same thing and think, okay, when I retire, I get this money that comes in, but you don't understand, there's tax breaks that you get and stuff like that. So, what would you suggest as an alternative if you were able to speak to the government and say, this is a bad idea?
Oh, man.
What would you say?
Do you know what? Like, I've genuinely thought about this a lot, and I think there needs to be education as a starting point. There has to be some kind of structured education, but again, because it's coming from the government, there'll be an element of suspicion from a lot of people. Like, I don't trust the government, this kind of tinfoil hat brigade. I think you could go a step further and either endorse or support specific kinds of investments and platforms. So if, for example, and I'm not saying this would be the case, if there was government-backed investments that were government supported and say, we're going to run a campaign on what a stocks and shares ISA looks like, we have got 5 different funds that you can invest in. We're going to support that. Not necessarily guarantee the capital because there'll be volatility in it. Like they did with stakeholder pensions years ago, you could drive the cost of that down, have it fairly low cost, and it would encourage people to start that investing. Maybe you encourage them with a bonus and say, well, if you put in 20 grand into a stocks and shares ISA, like they've done with the LISA, we'll give you an extra grand on top of that.
Yeah, okay.
Like that is the stuff that's going to encourage people to do that.
Yeah.
Alongside the education piece. But there's so many avenues to this. Like, what could that look like and what will evolve? And I think there will be solutions to that, just not necessarily instantly.
Yeah. But that's interesting. No, finish your thought, please.
No, I just think like, give the education, but there's got to be something at the back end tangible for somebody to do. Because if you've never invested before, just go on and look at investment platforms online, and there's a lot of them. Which one do you pick? And you will just become blind very, very quickly to it, unless you're wired that way and you've got the interest in it. And if you haven't got the interest in it, you'll just switch off and you'll just kick it down the line and say, I'll do that tomorrow. And then 3, 4, 5 years have passed and you haven't done that. And it happens a lot.
It happens a lot.
A lot. And it could just be really simple stuff. Do you know? Like I said there, just 5 investments that are either government supported or backed with a big kind of fund house, or a combination of lots of different fund houses together, getting their heads together. That could revolutionize the investment market and get people started.
I think it's about time, in the UK, that we kind of take investing a bit more seriously, like to the level that it's so serious in America. America is like, it's a proper thing for them. People get really excited about that. Like they're really into it out there. And you can kind of tell the whole ecosystem is like that, which is maybe why they can be so innovative, because there's got to always be, there's so much interest in investing out there that, like, if, you've got a kind of a new kind of idea, a new startup, it's guaranteed that they're going to get money, but that backing is kind of there because the culture is kind of there. And I think that we kind of lack that a little bit here. And I do like your idea. I think that would be quite good. Giving incentives are always cool, right?
Absolutely. Yeah. We've got, like, on paper, the best financial services industry in the world. Yeah,
which is so interesting, right?
And we're known for it. Yeah. Like, you just have to walk into the city, into that square mile, and you can see the investment banks and how London as a financial hub for the UK and the world has been built. Yeah. There are people within that spaces that could make this a lot better than what currently is being proposed, of just going from 20k down to 4k. Yeah. Engage them, get these people involved, and let's think about it. Yeah. And actually, if you do it on the basis of this isn't going to be for profit, it's about educating and getting people to start this process. Yeah. It's a win-win for everybody, right?
And the profit will come. I think the profit comes when you don't think about the profits. Like I said, use America as an example. A lot of them are thinking, okay, what's the next innovative thing I can do? Because it's providing value. When you provide the value, then you get the money, right? In a way. So, yeah, so interesting. I'm really looking forward to seeing what they do, because I think we just need to shake up things. Yeah. So, in terms of overpaying mortgage versus investing, we're going to talk a little bit about more about investing later, right? So right now, I did some research, right? So the average 2-year fix rate right now is 4.9%, and a 5-year fixed is at 4.74%. This is as of the 15th of March, 2025, people, just in case you're asking, because this fluctuates a lot. So the gap for me, I've noticed obviously the gap between, mortgage rates and stock market has narrowed, right? So my question is, does it make sense to overpay your mortgage or invest that money instead? And can you kind of provide examples of the pros and cons for each? Because it's narrowed. Before, it used to be a lot lower. So it was like, don't overpay. There's no point of it, right? Yeah. You can get better returns in.
It's such an individual answer.
Yeah.
And if you look at it from a pure numbers perspective, if you overpay your mortgage has gone quicker. Simple as that. Now, if that mortgage around your neck puts financial pressure on you and you're worried about it, then overpaying the mortgage is the right thing. But if you look at it from just the numbers, if you're a higher rate taxpayer, for example, and you decide you're going to overpay your mortgage, you've paid 40% tax on the money that you've taken out to then apply to your mortgage. So you might be over when you're paying your mortgage by £1,000 a month, but actually the reality is you've paid 40% on it, so it's more than £1,000 a month. You've paid 40% to take that money out. If that was invested into a pension, for example, You could be putting that, I think it's about 1,600 quid, could go into the pension and build your future wealth. Now, it's the forever thing of getting that balancing act right. It's a very personal thing. If your mortgage worries you, then overpay your mortgage. If it's the case, if you're worried about the long term and investing, and you want to get this started and you're worried about what your retirement's going to look like, then pension's the right answer. But from a tax efficiency perspective, the pension will knock spots off it all day long.
Yeah, then overpaying. What about investing? Just investing through stocks and shares?
Similar kind of thing, because I think if you look long term at like average returns, depending on what you invest in, that's going to be higher than average interest rates. And you're building that bit of wealth for further down the line. And actually, at some point, if your mortgage kind of keeps getting paid and kind of starts coming down and your investment balance is going up, they're going to meet at some point in the middle. And then you've got a decision to make. You could be like, well, I'll do the ISA to get to this point and then I'll pay my mortgage off.
Yeah.
You know, you could do a bit of both. And what you're also doing is you're getting that knowledge and experience of what investing's like, the ups, the downs, the good, the bad, and the ugly as well.
Yeah. And that's the thing. It's so interesting because I think it's like psychological for some people as well. The whole thinking long term, if I invest, like let's say, I don't know, again, this is just me thinking in terms of my head, right? Like you say, the period for you to meet is like 10 years of investing to have enough to pay it off. People probably may not be patient enough to do that or think that would work again so much. One, because of course the lack of education, we don't really do investing here. And because we live in the property, we kind of, trust, okay, it's a physical asset. I understand that. We're much more comfortable with investing in property. It's kind of normal. Buying a house is like a no-brainer in a way for most people. I think because of that, they probably feel like, okay, it makes more sense to just overpay than, invest. But from the numbers point of view, like you say, it makes more sense to just, but if that changed, right, let's say, is there a point where if interest got to, it would be like, okay, overpaying makes more of a sense? Is there a point? I know we can't say specifically, but is it like in terms of range, is it like 6%, 7%, 8%, things like that? Yeah,
I mean, if you look at it from that perspective, if you can get 9 or 10% investment returns and interest rates are 5% on your mortgage, you've got a difference of 5%, right?
Yeah.
So you're making money on top of that.
Yeah.
If the two of them are equal and interest rates on your mortgage are 10%, for example, and investment returns are 10%, a 10% interest rate on your mortgage will be very, very uncomfortable for a lot of people. Like you look at like the 80s when rampant inflation and kind of interest rates in that ballpark figure, like a lot of people were losing houses and just walking in the bank and handing keys back.
Yeah.
I think the damage of that would be huge. And I don't think we'll ever get to that point again. But like if you put in mortgage repayment calculator into Google, you can look at how much you can overpay your mortgage and the impact that's going to have. You can actually contact your bank, your building society, or your provider and say, look, I'm thinking about overpaying my mortgage by 100 quid a month. What impact will that have over the next 10 or 15 years? And they can run an illustration for you and let you know. And it could be that it saves years and years off your mortgage by doing that. It's a great question, and there's no right or wrong answer to it because everybody's individual. Like I've sat down with some people who have been massively overpaying it, and I've said, well, you're a high rate taxpayer. Like that's costing you like 1,600 quid a month or whatever it is to do that. And like, I've never thought about it like that.
That's what they said.
Yeah. And all of a sudden the penny drops, and they're like, "Oh, we could do something different with that."
Yeah.
And it's that again. It's that education thing. And if that went into the pension or that went into share save schemes with work, there's lots of different things that you could do.
Yeah. So that's so interesting that person. What kind of led them to think, okay, how did they get to that kind of decision to be like, oh yeah, I want to overpay my mortgage and not like seek to do other options like, I guess saving in a bank account, probably the rates weren't that great. But how comes, I guess, they didn't seek other stuff?
Financial pressure?
Yeah.
Look what happens. Look at what's happened with mortgage and interest rates recently. They've gone up and up and up and up. And a lot of people have bought houses at 1.5% interest rate, and they're coming to the end of 3 and 5 year fixes, and all of a sudden their mortgage payment's going up by 200-300 quid a month in the middle of a cost of living crisis. When inflation's so high and the cost of everything's getting higher.
That's crazy.
You're at a point where you're like, how am I even going to afford to pay the bills?
Yeah.
And then when that money does come in, it's kind of like, I don't want to be in that position again. I want to make sure I'm chipping away at that mortgage and making a difference.
Yeah. That's the thing. That's the thing. It's about chipping away. I think definitely for a lot of people, they just want to be mortgage free. But I'm thinking paying off 200-300K. Wow. I don't know. I just feel like I would just want that in investments. I just rather that in investments. And then I decide, okay, do I use a portion of these investments to pay off the house, or do I don't know, I just sell the house, or because I guess if you keep overpaying a mortgage, then yes, you're overpaying it, but then that money's in the property until you either sell it or remortgage it, which then kind of resets you back a little bit. So then kind of what do you kind of do? And yeah, that's quite, I guess that point is quite interesting in a way, right? I guess what factors should people consider if they're just trying to decide between the two, which one's like going to be better for them?
Like, what's the instant fix right now for you? What is going to if you're under financial difficulty or pressure right now, what's the instant fix? What's going to alleviate that pressure right now and the worry that you've got? Because a lot of people worry about finances and worry about money. And I think that is such a powerful tool and a thing to unlock and kind of understand. Because if it is that you putting 100 quid a month onto your mortgage is going to alleviate that pressure in case interest rates go up again, then that's the right thing for you.
Yeah.
If it is actually, I want to get started on my investment journey because I know I'm going to get left behind if I don't, and I want to be able to have a holiday when I retire and do all those other things, then investing's the right option. And something that you said there about downsizing properties and kind of releasing equity from the property, interestingly, loads of people say they're going to do that, but not many people actually do. And you'll have heard it as well, like time and time again, people say, oh, well, my pension is my house. So you telling me you get a retirement in that house that you've grown up with your kids and your grandkids and all these memories and all this stuff that you've got around you, you've built up in this lovely home, you're suddenly going to downsize the 2 or the 3 bedroom or the 4 bedroom house and go to a little 1 bedroom flat to cover your pension and retirement? Because the reality of that is very different to what you think it is. And a lot of people say they're going to do it and a lot of them don't.
Yeah.
Like, that's a tough decision.
It is a very tough decision.
Because you've got all these years of memories that you've got to condense down and all the stuff that you've built up over the years. And you've got to get rid of all of that and cram it into this little tiny place. Some people are just ruthless and be like, yeah, that's exactly what we're going to do. Like we've got 4 kids at home. Like we don't need a 4-5 bedroom house. Unless grandkids come along and then all of a sudden it's a little bit different then because you'd be like, well, actually I want somewhere for the grandkids to stay. Or like I have a midlife crisis and have a man cave and one of the kids and then move out, you know what I mean?
That's the thing. It's easier said than done. You're right. If you're putting all your wealth into the property, you kind of got to be sure of what you're doing at the end. And again, it goes to the question, why are you overpaying? Because some people don't need to. They're just overpaying just because they want to be mortgage free, not because there's any financial pressure. Okay, you want to be mortgage free, cool. What's the benefit? Yes, the benefit is that you're going to no longer have these mortgage payments, right? But what are you losing out by kind of doing that as well, right? So in terms of investing, right, despite it being higher risk, what are kind of the benefits for people to, again, listening, especially if they're considering to, they want to overpay their mortgage? What's the benefits of investing?
Long-term returns are significantly better. What are you going to get? Cash. Like the way to think about investing is it's a way to consistently beat inflation over a period of time. And yes, there'll be times when markets drop like it's happened recently. And if you kind of based investments are heavily based in the US, you've probably seen a drop of 5, 6, 7%, if not a little bit more over the last few months. And that can be difficult for a lot of people to kind of hold their nerve. Yeah. But what that's doing is that's building a pot for future you. That's like the point where in your 50s and your 60s, you can have access to some funds to be able to step away from the 9 to 5 and live the life that you want. And when you're in your 20s, you're thinking, well, that's going to be like, that's 40 odd years away, man. I've got a long time before I'm going to get there. It'll be there a lot quicker than you think. And it's just building that. It's your future paycheck. That's what's going to pay your bills and keep the wolf from the door and keep the lights on and maybe stop you having to downsize because you've got that financial pressure. That's what investing can do for you. Yeah. And the biggest thing, and you heard it before, It's timing the market. Like, don't try and go Wolf of Wall Street and try and time the market and do the old, we're going to buy them low and we're going to sell them high. You get that wrong and you can have a serious impact on that final result for you. But staying consistent is where you build the money. And it's not sexy. It's not necessarily interesting, but just a consistent 50, 100, 200 quid a month or whatever it is. Put it in, stay consistent, keep doing it.
Yeah.
That's where you build the money.
Yeah, I agree. And I always, this is why I talk about investing a lot, because I'm really trying to get a lot of people to just keep on investing because it's so important and it's so, powerful. On the other hand, right, I always want to kind of highlight the risk to people because I think it's important to highlight risk because if you tell them up front, I think they're more likely when it happens, they're not surprised, right? They understand there's risk with it and they can kind of continue doing it, right? So I guess obviously from an investing point of view, how much more risk is involved in investing versus like if somebody's going to try and, overpay their property?
It's big.
Yeah.
Like bricks and mortar in this country are the safe option, aren't they? Like we're conditioned to think like bricks and mortar are the safe option. If you look at like on the continent, property ownership as a percentage of the population is way less than in the UK. Like we've got this obsession with getting on the property ladder within the UK. But in terms of risk, yes, investment's going to be risky because it goes up and down. It can do that over a period of time. But like take a step back, like zoom out a little bit, look at the bigger picture and over a 5, 10, 15-year period. Yeah. You've got the investment returns that you can get on a fact sheet and it will tell you what the fund's done over the last 5 to 10 years. And obviously put the caveat in, past performance doesn't indicate what's going to happen moving forward. Yeah. But you can see what that fund's done and get a feel for like what's the volatility and you'll see it in a chart. And investments go up and down like this. If that makes you nervous, then maybe investments aren't quite right for you at that level of risk and you want to do something a little bit safer. Like to get to that end goal of having a comfortable retirement and having money to be able to do the things that you want to do. Yeah. It's a combination of a lot of different things for a lot of different people. Yeah. I know people that have done it with property and done very well out of it. I know people that have invested in property and it's been a total disaster and they've just hated it. Exactly the same with investments, exactly the same with pensions. People kind of, and like you see it as well, like people still think pensions are a scam. I see it a lot, man. Like I did a post last week on TikTok and the title of the post and kind of invited a bit of comment was pensions are a scam. But it was like done tongue in cheek. You put money in, your employer tops it up and you get tax relief. It grows tax free and you get 25% tax free. And lots of people are like, yeah, pensions are great. And then other people are like, yeah, it's total bullshit. It's a scam. It's this, that, and the other. And you're like, wow. Like, really? You still think that stuff? Yeah, definitely. Look, people who want their help and will leverage these tools will be the ones that leverage it. Some people will not, unfortunately, right? Which is a bit of a shame. And we're going to talk a bit about risk appetite because I think that's quite important for people to understand. Like, okay, how do you kind of determine your risk appetite? So you said something interesting earlier, right? People wishing that they could, start earlier. Even me, that's one of the wish. I wish I could start investing 5-10 years early. I wish I started investing when I was bang on when I was 18. I could get stocks and shares ISA. I could start investing. I wish I could do that. So I do get often, I hear from people, all types of ages, 30s, 40s, 50s, who have actually, commented and said that, I feel like I'm starting investing late, right? Is there ever an age where it's truly too late to begin investing? No, never. And I think what you've also got is if you're a parent and you've got young kids or even nieces and nephews or younger people that you're in contact with, you can pass that information and knowledge to them so they're not sat in their 30s and 40s saying, I wish I'd started sooner. Just like the habit. It's the habit that's going to get you to that point of having freedom. Yeah. And ultimately, like we're talking about investment returns and all that kind of stuff, what it does is it gives you time. Like it gives you time to kind of maybe when you get to 55, you can kind of say, look, I'm sick of the 9 to 5 and the rat race. I want to work 2 days a week. I want to spend time with my grandkids. I want to play golf. I want to do all the things that I should have done when I was younger, do traveling. It gives you time and it gives you options. And the sooner you start, the bigger that is and the bigger that time back's going to be for you.
Yeah. But it's never too late, right?
Not at all.
You can always start investing.
No, not at all. Like it can always make a difference. There's a bit of a reality check for some people though, because actually if you're saying, I'm in my 50s and I've got no provision in place at all, you're going to have to go hell for leather on that to really get something behind you. But retirement's a very different prospect from what it was 15, 20 years ago. Like I can remember going to my nan's house in Newcastle at 65 and she stopped work and just sat on a sofa watching TV all the time. Like that was her retirement on a state pension, and she could get by on that. Like it didn't need to have a lot of money. That's very different now. And the other thing is, like, a lot of people will have phased retirement. So you'll get to in your 60s and maybe you don't want to do the 9 to 5 anymore, but you could go and stack shelves in a supermarket, you could go and wait tables in a coffee shop.
Yeah.
That's a very, very different kind of, pressure's the wrong word, but it's a very different proposition than having to go into work and slog away at the 9 to 5 to pay the bills. It might just be you do that to get an extra bit of pocket money, or it is to pay the bills. But you can go and find another job and do something differently. That side hustle culture that was mentioned earlier as well. Like, there's things you can do to generate income. There's never been a better time to be able to do it.
Yeah. So that's the thing. It's never too late to invest, but depending on your age, maybe there might be harder work to do, but it's never too late. And I think I want people to understand that, because I had somebody, we had a pension episode at this point a few weeks ago, and literally one of the comments was, I'm in my 50s, I've got nothing. I've got no pension or nothing. It's too late for me. That kind of talk. And I'm like, no, it's not too late for you.
No, it's not.
Because, okay, let's say you do like state pension age, which I can't off the top of my head. Right?
That'll be going up to 68 as well.
68. So that's 18 years. What are you talking about? 18 years invested is good money. So you're not too late, right? No. Like, I'm just like, I just don't believe in just giving up so early and just saying that it's like, it's too late for me. Yes, it would have been nicer if you had 30, 40 years to invest, of course. But, you know, we all have different journeys. So I just kind of want to just encourage people to kind of don't think it's too late. I said the 50. I had somebody who was 38 that told me they're starting this late. So it's just like, okay. So people think at all ages. I probably even have people in their 20s thinking, I'm late. I'm late. Like, why am I starting now? You know, kind of thing. And just to encourage them to just start with whatever they can kind of do. So do you still think, though, if you do start later, it's possible to build significant wealth if you start investing later and have a shorter time horizon?
Yeah. 100% is. It's just define what wealth is for you and define what that number is, because actually retirement isn't an age, it's a number, i.e. it's an amount of income or capital that allows you to kind of step back and do the life and have the life that you want, your dreams and all the rest of it. Is it going to be the life that you've kind of dreamed of since you were a little kid? Maybe not. Maybe there's a bit of a reality check and a bit of adjustment, but it's more than possible. It's more than possible. Yeah. And it might be that in reality, you have to contribute more and you have to kind of pull the purse strings in. It might be some short-term pain for some long-term gain. Yeah. But if you're going to live it well into your 80s, like, do you really want to be worrying about, can you put the lights on? Can you put the bills on? Yeah. You
definitely do not want to worry about that.
No, at all. Definitely don't, yeah. It's because, like, state pension years and years ago, if I go back to the example of me nan, that was enough for her. Like, 11.5 grand is £11,502. 11.5 grand a year. Could you survive on that?
No.
You're not going to do that in London.
Definitely not.
No, not at all.
Definitely
you
not.
know, and like, that's tough.
Yeah. It's very, very tough. And you mentioned contributing more if you're like catching up. Is there anything else that people can kind of do to, I don't want to say catch up, because that's how they feel. Yeah. That's how they're going to feel, right? Yeah. You can't take that away from them. But is there anything else that they can kind of do to catch up? You mentioned contributing more and, you know, to your investments.
I mean, in theory, and I'm not saying everybody can do this, you can take more risk. But again, if you're not sure what you're doing, make sure you use a professional, make sure you understand this stuff. But by taking more risk, you're potentially going to get a better return, but that also means you're increasing the volatility. If you're really, really worried about this stuff, follow financial creators online, learn the basics, learn the fundamentals. And if you're in a position to be able to do it, then maybe you contact a financial advisor. Yeah. The other thing is, if you're employed, speak to your employer. Like, what can your employer do? Could your employer get somebody to come in and talk about this stuff to you so you get a different understanding of it? That can help. I think employer schemes, like pension schemes, a lot of the time, the vast majority of people go into the default funds on the pensions, which on the grand scheme of things, probably not the best decision.
It's not best, yeah.
Because they're just average funds. I think there should be a responsibility on some of these pension providers to offer better options and better education and better funds, because actually, like, you start work and you go into work and they say there's a pension scheme and you need to log online and pick what you want and pick the funds, and you go to your HR department and say, I don't understand this, and we can't give you advice, sunshine. So then you'd be like, okay, well, what do I do now? Go to a financial advisor. When you say to a financial advisor, I need advice on what to do with my workspace scheme. All right, that's going to cost you 1,500 quid or $2,000. Then you just go back into limbo. You pick the default funds. 20 years go by, and you've been averaging like a 2 or 3% return. It happens, and I see that stuff a lot.
Yeah.
Like those default funds, should they exist? I don't really know.
I don't understand why. We need answers to that question, because why have they chosen that as a default? That's what I'm thinking. Why not something a bit like, at least that's going to give you, okay, maybe not the highest return, but at least middle of the ground. It's just this weird.
There's a really simple fix to this, and this will be quite controversial. and I think what potentially could happen is you should automatically be put into a higher risk category of funds until you get to the age of 45 to 50.
Yeah.
Because if you've built up that level of wealth over a period of time by consistently contributing, and your employer and your tax relief on top of that, when you look at low, medium and high risk funds over a long period of time, the differences in returns are huge. They're big numbers. And if you compound that over a period of 30 to 40 years, they're big differences.
Yeah.
And if it was set in stone that actually those funds were in higher risk funds, managed properly, absolutely, low cost, but for example, in an S&P tracker, which averages a return of 9 to 10% a year, if that was fundamental for everybody and that's how pensions worked, you've addressed a lot of those shortfalls further down the line just by doing that. Because people just don't understand this stuff, and they'll pick, shall I have low risk? And you think, well, I'm not going to do low risk, and this is what the vast majority of people do. Low risk, might as well put it in cash. High risk, Wolf of Wall Street, I'm just going to go moderate risk. The amount of clients I've seen over the years that come in with a work-based scheme, and I'm like, what level of risk you take? Moderate risk. Why did you take moderate risk? And I explained it to them, and they were like, that's exactly why. Because I just didn't understand it. I didn't want Wolf of Wall Street, and I didn't want cash, so I went for that one.
Exactly.
Education again,
It is all education, but this lack of education is going to have a big impact on people. Like you say, the compound, if you're on a low percent, 2-3%, and you're losing out on 5 to 8% a year over 30 years, the math is ridiculous, right? You might be losing 2 times the amount of money, opportunity cost, right, of losing that, which is bad because you've worked hard, you've contributed to your pension, you think you have enough for retirement, and maybe you don't quite have enough because you didn't invest in the right thing rather than you didn't contribute enough. That's sad. I think that's sad.
Yeah.
Right. And I like your idea, but will they do it? Probably not.
No, not at all. I mean, at the same time, there's a simple thing that everybody can do, right, as an exercise. Log onto your pension scheme or your investment funds, find out the fund that you're invested in. And every fund in the UK will have a fund fact sheet, or what's called a key investor information document, a KIID. And the idea is you can get a 1 to 2 pager snapshot of what that pension fund is. Scroll down to the bit where you can see the long-term returns of the fund. Some of them will have up to 5 years, some of them will be 10, some of them might only have been going for a couple of years. Look at that return over a 5 or a 10-year period and average out what that annual return is. Right? So you've got your figure. Let's say it's 3% average annual return. Go to a compound growth calculator, put that number in as a 3% annual return, put how much you're contributing to your pension, hit calculate over how many years until you get to 65. That's what your pension's going to look like. If that scares you and that isn't going to be enough for you to retire on, you've still got time to do something about it. And those fundamentals of working that information out can make a big difference to you.
Very big difference, yeah.
Because all of a sudden you're sitting there, 3% ain't going to do me. Factor inflation into that on top of that, 2 or 3% a year. Like you're losing money if you're doing it 2-3%.
Pretty much, yeah.
Do you know what I mean?
You probably, it's not going to be grown by much, right? It's going to be worth the same as it was in 30 years, which is, that would be diabolical. That would be bad for a lot of people. Yeah. I'm not looking forward to that time because it's a bit of a worry because I'm just like, seriously, like this problem is becoming bigger and bigger especially with the type of inflation we've had for the last few years, is becoming a bigger and a bigger problem. So for me, I've mentioned this before. So I was on a workplace pension and I changed those as soon as I could. Doing what I do, I change those into global funds. So I don't worry about that kind of stuff. But yeah, Yeah, people go and check your workplace pension. So, we talked about more risk potentially, but on the other hand, why may it not be the best thing for, and we're not talking for pensions, by the way. Sorry, I mean from an investing point of view.
Yeah. If
those people trying to catch up, take on more risk, maybe it might not always be the best idea. Why might it not always be the best idea?
Are you going to worry about it? Like, or if you're putting money into a stocks and shares ISA or a pension or any other form of investment, and you see your funds drop 5, 10, 15 or 20%, which can happen in investment funds, are you going to panic? Like, emotions and managing your finances are your enemy when it comes to investing long term. If you see a fund drop 15, 20%, what's your reaction going to be? If it is, oh my God, I should never have done this, I'm going to pull my money out, you've just crystallized that loss. That it's easy for me to say because it's not my money. If that's your life savings and they've just dropped 20%, you'll be worried. You'll panic.
Definitely, yeah.
And I think, like, as much as taking risk is a solution to it, what you need to understand is the level of risk you're comfortable with over the time frame that you want to invest for. Like, over a 5-year window, if you need that money in 5 years' time, you're probably going to take less risk than, I've got 40 years before I'm going to need this. And you can take a bit more if you're kind of looking at longer term. Put it into a risk questionnaire. Like, just Google risk questionnaire.
Yeah, I like that.
There'll be loads of that will come up.
Yeah.
And what I'd encourage anybody to do is think about it twofold. So, first of all, complete that risk questionnaire as in, I need that money in 5 years' time.
Yeah.
If I'm going to have that money in 5 years' time, what level of risk am I comfortable with? And go through the questions. They're really well structured and they'll give you that's the risk level that you start with. Then go back and complete it again with a view of, I'm not going to need that money for another 15 or 20 years. Would you answer it differently?
Yeah.
And if you are answering it differently, then you've got 2 different risk levels you can work with. And I think a lot of the time, certainly the traditional financial advice space can concentrate on just one risk level. And that's not going to be right for a 5-year one and a 40-year one at the same time. You need to have 2 different approaches.
What's that risk level that they look at?
In terms of what? Like the investments?
You said that they only focus on one risk level.
They'll just do like you'll do one questionnaire.
Oh, really? Okay.
And it'll be like, there you go, after you've come out as a moderate risk, so therefore I'm going to recommend a moderate risk investment for you and a moderate risk pension. When in reality,
it could be 2 different. Okay.
The challenge is, and the FCA have rightly done this, and it's the right thing to do, by the way, is as financial advisors, we don't want to have an influence on our clients when they complete that questionnaire. Because you could have a conversation with a client to take more risk than necessarily they're comfortable with, and that's not always a good thing. But what it should be is a starting point. Like, you come out of moderate risk, okay, Mr. Client, you've come out of moderate risk, what do you understand about that? What kind of funds do you think are moderate risk? And that education of building that up without influencing the decision that they're going to make and the final outcome of it.
Yeah. I think the risk is, like you say, education. If you're also helping them say, okay, you're moderate risk, let's go through what investing is. Do you actually have an understanding? What is investing? Okay, this fund, let's look at this fund. Do you actually understand what this fund's doing, potential returns, what assets is invested in, what countries or regions is invested in, right? If you're having that kind of conversation, then you're not really encouraging them, but then you're trying to gauge what their education level, because again, like, it's just words, right? High, medium, low. If you're the type of person, because there's some people who they just not risk averse as a personality, right?
Yeah.
And you're just like, high, you're going to be like, oh yeah, I'm high risk. Let's say like I don't want to say this like that, but like, let's say like gambling, whatever, like, oh yeah, I'm high risk, right? You're going to be like, high risk, right? That doesn't mean just because you're high risk that you're educated, right? It's 2 different kind of things. So I like the risk questionnaire, actually. We've never spoke about that on the podcast, and I think I would encourage people to kind of do that. But I think the education is key, because if you understand, then you can kind of understand what you can stomach, like you say, as well. And
I think, like, if you look at COVID, right, and this is what I kind of love, like when you look at fund fact sheets for any fund that's in the UK, they've all got a fund fact sheet, or like I said, a KIID. Most of them will have a chart, and you will see a line of what that fund's done. What I loved about COVID is you saw a massive drop in a lot of funds. And if you're looking at that drop, and that drop is 15 or 20%, and that makes you nervous, which it probably should do, you've seen the good and the bad side of investing, because your funds will drop over a period of time.
Yeah.
And on that chart, you would see the drop because a little kind of wiggly line going in a general direction of up, like most people would see the general direction of travel. But if you're seeing, crikey, there's a big drop right there. And when you explain that to clients properly and go through it, be like, that's the good side.
Yeah.
That's the bad side. What do you think about this bad side? What if that happens to you just before you're about to retire?
Yeah.
Or what if that happened to you tomorrow? What would you do?
Yeah.
That stuff needs to be explored and talked about.
Definitely. And this is why we have these conversations so we can like bridge the gap for people. So I was wondering about global index funds and ETFs, right? Is there actually, first of all, what's your thoughts on them? How do you feel about this? Because a lot of people talk about them, generally speaking. It's like kind of like the go-to global funds and, you know, S&P 500. Those are like the two go. You got to be in those and just, you know, buy and hold, and you're going to be good. You're going to be building wealth. What's your kind of overall kind of thoughts on those two?
I think for the vast majority of people, they'll be absolutely fine. Like if it's just going to get you started investing, and then maybe as you become more sophisticated, you might want to have some different options like specialist sectors or whatever. I think those kind of funds, you're investing in the whole market. And obviously the whole market will crash at some point. Like markets will go up, markets will go down. So if world markets change, you could drop 15, 20% in those funds. Like that's not necessarily a bad thing because you're investing in everything. You're spreading that risk out as much as you possibly can. Yeah. Like you're not going to put all your money in Japanese yak farms that are going to potentially deliver a ridiculous return. What you're doing is spreading that out as much as you possibly can. I think by investing in the whole market, you reduce that volatility and risk level down because on each one of those charts that you see, you'll see where it's invested in the US, Japan, UK, and all that. You get the breakdown and you can see the companies that it's invested in. All those names on that top 10 holdings list familiar to you? Yeah. Is it Meta? Is it Apple? Is it a lot of kind of US funds? And the reason why global funds are heavily US weighted is because historically it's been one of the best returning markets. Yeah. I think for the right investor, they're absolutely the right things to do. And investing in the whole market's a big thing because even good fund managers, exceptional fund managers, still get it wrong. And if you're investing in these funds, you get in the market, it's very difficult to outperform that. Like you look at Warren Buffett, probably the greatest investor of our generation. He says the same thing. He says the same thing as what I'm saying. The vast majority of people are better just putting their money into an index fund. He's saying that for a reason. But if you want to get access to kind of Berkshire Hathaway funds and the stuff that they invest in, you're going to have to pay the big bucks to do it. And you're going to have to pay some fees to do it. The vast majority of people, index trackers work effectively well, but it goes back to that whole planning piece of the start, figuring out what you need to survive when you get to retirement and then reverse engineering it back with a well-structured plan.
So you're a fan of the global index funds, S&P 500.
I think any kind of fund that encourages people to invest, that's talked about consistently, and encourage people to do that is a positive thing. Because you just get that awareness, and it's so well spread out because you're investing in everything that's out there. Yeah,
it's true. It's very well diversified. It's very hard to beat it. To be honest. And do you think that there's let me not say age, kind of an age where it becomes riskier to hold? So let's say I've invested in global index fund ETF from like 20 to 50, so I've done it for 30 years, but I'm still in it beyond 50. Do you think it still makes sense given, obviously we know that it's a little bit riskier. Is there a time where it might be too risky to even be invested in global index funds?
Oof, it's such a personal thing.
Yeah.
I think that's a really difficult thing to tie down, but my kind of view, historically what happened is you'd get towards retirement, right? And you would take your pension pot and you'd go to an annuity provider and say, I've got a pension pot of 200k, can you give me an annuity? And they'll say, well, based on your height, weight, the benefits that you want, we're going to give you X% a year as a return. So what you would want to do is on the 5 years before retirement, you gradually de-risk that portfolio. So by the time you get to retirement, one, if markets drop 20%, most of your funds are going to be in cash anyway, so you're not going to be affected by it. And two, you can then go to that provider and say, well, all of my funds are in relatively low risk. I want X. Now, when that all changed and pension drawdown became more widestream and everybody could do that, that model still works for certain people. But the reality of it is you're going to get to 60 to 65, maybe when you want to retire, you're potentially still going to have those funds invested for another 15 or 20 years. So we've really then got to start thinking about, well, if I do that and go into lower risk funds and reduce my risk level down and I get a return of say 4% a year, I'm taking 5% a year out of it, or 4 as the magic number, as a lot of people say. You're starting to eat into that capital and kind of use that and bring it down. That's not a bad thing. It's such a personal thing, but that's why like the expertise of somebody at that point who knows what they're doing and look at the intricacies of it can make such a big difference.
Yeah. It's so interesting because you're absolutely right. If you do put it lower, you're going to start eating into your investments, which I think a lot of people don't want to because they want to pass it on or they want to have it for longer. People just don't want to eat into the investment. They want to eat on the capital appreciation part of it or the income that's kind of generated from it as well, which is, it's very, very interesting. Okay. I know it was a tough question, which is why I want to ask you, but I wanted to think about it a little bit because I'm like, is there a point where actually you start moving away from global index funds and stuff like that? So for those that feel it's too late to start investing, how would you reassure them and encourage them to take action today?
Wow. If you've got a pension, you're already investing. So you're already an investor. If you haven't got a pension, why not? And I think have a conversation with somebody in the financial services space or follow some content creators and build your knowledge bank up and do it quickly because investing is for everybody. And I think it's almost seen as this, well, I'm only going to invest if I earn X amount. Yeah. Or I've got this salary now, I'll start investing when I get the next pay rise or I get my next bonus. But life gets more expensive, things get in the way, and you always keep kicking that can down the road. And then you get to 40 and 50 and like, I should have started a lot sooner. It's for everybody. Get started, build your knowledge up. And even if it's a case of you pick a fund, but you don't actually start investing, and you just learn about that fund, what it is, what it does, how it works, the fund provider. There's some incredible financial education stuff out there already from a lot of the creators that we know. Follow them, learn this stuff. Maybe you go on an investor course with some people that are relatively low entry points. Or maybe you do use a financial advisor and the financial advisor sits down and gives you that knowledge. Like I'm a massive believer in that. I would love all my clients to turn around one day and say, I don't need you anymore. Like that'd be amazing. Like, because actually what I've done is then I've built their knowledge up and built a plan that works for them to be able to say, I'm good to go on my own. Yeah. Like that'd be great.
Yeah. It's important. It's important if you're self-sufficient. I think there's definitely value for a lot of financial advisors because there's a lot of complicated things and it's like stages, right? Like if you start in from, baby steps, you're building, you've got a huge amount of wealth and then you kind of need that expertise, advice at that point to kind of do things. And that's where, a lot of value could definitely be added as well. So for people today, I guess what would be, especially those people that haven't invested, what would be those first simple steps for them to be able to like make their first investment today?
It would be to find some kind of self-invest platforms and do some research on the platform and have a play around. Like say, for example, you find 3 platforms, have a look at those platforms. Do you like them? Does it feel comfortable? Do you feel confident going through the process of setting something up? But I think you almost need to go back a step first and think, first of all, have you got an emergency fund like we talked about earlier? First step. If you haven't got the emergency fund, you've got to focus on that first. Second thing, have you got any high interest debt? Credit cards, loans, Klarna, like the high interest stuff, get that paid off first because that is expensive. If you've got the emergency fund and you've then got your high interest debt paid off, then start thinking about what major expenses have you got in the next 5 years. If you've got some big things coming up, maybe you allocate some savings, not investing, to that. And anything beyond those 3 pots, then maybe that's like the pot that you start thinking about investing. Without those 3 foundations, investing, take it off the table till you've got that. And then it's exploring investment platforms, looking at options and figuring out. And if you get lost and confused, find a professional. Yeah. Because even though it might cost you to do that, if you get the right advice and you get it set up properly at the start, and a lot of advisors will do this, it doesn't have to be an ongoing relationship, could just be a one-off. Yeah. Sometimes you're good to go. And you might be good to go for another 4 or 5 years before you need help. You might even be longer and you might just want to get things set up, set it, forget it, look at it in 10 or 15 years' time.
Which is true. And in terms of emergency fund, how much do you how much savings do you recommend? Kind of
like typically 3 to 6 months.
Yeah,
it is the kind of the official FCA guideline stuff. Some people want 12 months because they want a little bit more protection, I guess.
And that's 3 months expenses.
Essential stuff, and this is the blurred area, right?
Yeah.
Like, what's essential for you? Because your essentials will be different to mine, right? Like, and I'll have. Might be the mortgage, might be the rent. And if going to the gym's really important to you and that's essential for your life, then that's on the essential list. If having a coffee on the way to work is essential for your quality of life, maybe it's that. If the stuff out there that isn't, right, what can you strip out? What can you remove? Work that figure out. Work out what you need to survive on a monthly basis, times it by 3, times it by 6. Keep it in an instant access account. It's there if you need it.
Okay. That's cool. I like that. Thank you. Thanks for that, because I think it always helps people to understand kind of like what's the starting point for kind of people and where they kind of got to start. So, okay, let's assume somebody's kind of figured out the platform, they've selected a platform, they've opened a stocks and shares ISA. How do they think about, okay, what do I invest in? Because that's where it becomes very difficult, right? You've done all the platform, you've got a platform that's low fees, you've opened your stocks and shares ISA. How do I make my first investment?
It's hard. Like there's in the pension arena in the UK, there's 8,500 different pension funds.
Oh my god!
So you've got to narrow it down to one fund.
Yeah,
that can be really challenging to do. Start with your risk questionnaire, like we talked about earlier. So your risk questionnaire, when you complete that, will give you a level of risk. Yeah. Now, typically, when you look at a fund fact sheet, risk goes from 1 to 7. So if you've come out as a moderate risk one, you'll probably come out as a 4. So you can straight away dismiss everything either side of that. So then you've got down to funds that sit in that category. And you've still got a lot of them to work through. And maybe something will kind of be familiar to you, i.e. you've got that in your existing pension scheme at work. Maybe there are other funds that somebody you know is invested in. Maybe you do like an S&P 500 or a world tracker. Narrowing that down is a challenge, but I think it's just about getting started and learning as you go. Yeah.
I like that. I like the fact that you say do your risk questionnaire first, because that could narrow it down to you. The other thing that I liked, and I don't know if people caught this on, is the fact that you're saying kind of like a fund first, which I think makes sense. Because actually, when I first started investing, actually my very first investment, I started with a fund. I started investing in the funds. They didn't perform that great, but I started there. I didn't really lose money. So it was like, I think I became comfortable with investing because I didn't log into my account. Oh my God, I've lost 100% of my money. This thing is a scam. I'm never going to do this again. It was like, okay, it grew. I don't think it grew much. I think maybe I didn't even lose much. So there wasn't much difference. So I think that's a great suggestion, because it means that there's going to be a level of stability as well. Yes, your money might go down, but it might not be crazy, like a 50% drop or 60% drop or even a 30% drop. So yeah, I think that's definitely a very great suggestion. So wanted to also mention and talk about behavioral science, right? And money, because I know that you're quite passionate about that. I guess, what are some of the common psychological biases that affect how we kind of manage our money and our investments?
How your parents manage your money is a big one. Like, cognitive behavior for a kid is set by the age of 7, so you're most likely to manage your finances very similar to how your parents did, and that'll be set from very early age. Like, was money scarce? Was money abundant for you? That has an impact on how you manage those finances. And it could well be that you get to 18 and you want to push back and rebel against it, and you go the other way, because there's lots of other things that could have an impact on that as well. That's huge. Has a massive impact on it. But in a positive way, you can do that with your kids. You can have a positive impact on them, have a positive relationship with money. And one of the things I talk to clients about is, one of the questions I ask them is, what's your relationship like with money? And you tend to get the same thing. Oh, it's okay now. It wasn't so great in the past. I got loads of credit card debt. I did X, Y, Z, but now I'm a little bit better. All right, why? Like, why are you better managing your finances? Because I learned from those mistakes. So if you can impart that wisdom onto other people and stop them making those mistakes, they've got a better relationship with money from the start. Yeah. Reading books is a big thing as well. Like,
very big thing. Yeah.
The Psychology of Money, like, perfect example of that from Morgan Housel. Great book. Rich Dad, Poor Dad. There's Richest Man in Babylon. There are so many finance books out there that you can just pick up, and these aren't super technical, information heavy books. You can find them if you want them. but just get one.
Yeah.
I think it's a great starting point for any kind of finance thing would be The Richest Man in Babylon. It's a story,
I like that one.
style.
It's quite good, yeah.
It's very easy to read, and those concepts gradually start to sink into your like subconscious.
Very good one, yeah.
It's great. It's a great read. I encourage anybody to pick that up and read it.
Yeah, it's a very good one, and it's a short book. I think it's like 100 pages.
Yeah,
it's 150. It's very small.
It's an easy one to pick up. Yeah.
I like that because it uses a lot of analogies, and I love analogies because analogies are like, oh, I get it.
Yeah,
that makes sense. So, are there any kind of strategies that you think that could help people overcome some of these financial biases that we may have? So obviously there's some, financial biases like loss aversion, of course, feeling a loss more than a win, and overconfidence as well. Is there any kind of strategies to help people understand these things, but also kind of overcome some of them as well?
Sometimes it's very hard to do that yourself because it's one of those things where you can't see the wood for the trees.
Yeah.
And you kind of, you'll think, oh, I'm okay with a 20% loss on my investment, like a loss of vision. Yeah. But when it happens to you, it might react very, very differently to what you thought. Looking at like coaches that talk about this stuff and will dig into the psychology and the behavior around how you manage your finances is probably one of the most important things.
Yeah.
And it goes back to the fundamentals and foundations of the emergency fund, paying your debts off and all the rest of it. Because anything else that happens and kind of curveballs that come your way, if financially you're prepared and resilient to be able to deal with that, takes the pressure off some of that stuff.
Yeah. So it's almost not being invested in a way where you're financially under pressure, right? So you're invested, but you're comfortable. Like you say, you've got your emergency fund, you've got your other savings, you're financially good at home. So if your investments go down, you're stable, you're fine. It's okay. You can kind of deal with it. You don't need to be in a place where, oh my God, I need to withdraw my kind of investments, right? And those kind of things won't impact you as much. Yeah.
We need to normalize talking about this stuff as well, man. Like, would you go and have a conversation with your mates in a pub or have coffee or wherever, talking about your finances and your money? Probably not.
Probably not. No.
You should.
Yeah, you should. Yeah.
Because actually they might be going through similar stuff to what you've gone through, and you might have something that's really good for them. Like talk to your partner, talk to your kids, talk to other people. And it doesn't have to be, tell me how much you've got in savings and investments. Yeah. It could just be, I'm a little bit unsure about what to do with X, Y, and Z. What do you think? And they might come up with something really good. It might be total and utter nonsense, but by getting some information and conversations with a few different people, you'll start painting your own picture.
Yeah, yeah. And, more importantly, right now, like we mentioned, the stock market is down, and I know that it's probably causing a lot of emotions because everybody's talking about it, is like probably causing a lot of problems. For me, I'm like, I just look at it like, oh, this is an opportunity. I even want more money to invest right now. But so I guess how can understanding behavioral science help investors avoid making, emotional decisions during market volatility, especially during these times where you're kind of seeing like, the S&P 500 global funds like go down a lot, right? How can, them understanding behavioral decisions impact that?
Think about the big picture. What's your goal? Why are you doing this in the first place? And just keep coming back to that.
Yeah.
Markets will go down, markets will go up, markets will change, they'll fluctuate. What's the goal for that money long term? And if it's really, really crystal clear what that goal is, that will just ground you enough to kind of think, don't panic, sit back, everything's going to be fine. If it's not clear enough, i.e., I keep going about this villa in Spain thing, and I don't know where it comes from, but like if you want to retire in Spain, like where in Spain do you want to retire? What does your apartment look like? Can you imagine sitting there when you retire? How are you going to spend your days? Who's it going to be with? What are you going to be wearing? What are you going to eat? What are the restaurants like? Paint the picture. Like engage your emotions in it and get that really clear. If you've got that grounding of where that North Star is, the rest of it is almost a little bit of noise, and you can just sort of filter out and think consistent. Stay consistent with it.
Yeah. And how can behavioral science help people, budget and save better as well? How can they think about that to enable them to do that?
Great question. And I think a lot of it is self-awareness. What's your blind spots? It's very easy for me to sit in front of a client and go through a budget planner with them and say, on paper, you should have £1,500 a month spent. And they'll go, oh my God. But reality is, like, we've got an out left at the end of the month because I can take the emotions away and look at it. Like it's hard to do that when you're in it for yourself, to take those emotions away and to be able to push some of those biases aside, push some of those beliefs aside, and have a real honest reflection. But this is where the number side of it is really important. The numbers on the page will not lie.
Yeah.
Face the reality, black and white, and figure out where you're at. But understand your blind spots. Like if you've got a blind spot, like if you know that every payday, you're straight into town, you're going to go and buy yourself some lunch, you're going to go and buy yourself some clothes, you're going to go out for a night out that night, and 2 weeks into the month, you're absolutely skinned. Like your blind spot is payday. Like what can you do to manage that a little bit better and disrupt that pattern? Atomic Habits by James Clear is a phenomenal book about habit stacking and how to break bad habits. I'd suggest anybody reads that. It's a very, very easy read. It's incredibly good. It will allow you to analyze where your bad habits are, where your biases are, to break them if you need to, but more importantly, stack the positive stuff.
Yeah.
And it could be just really simple of when you clean your teeth in the morning, which takes you 2 minutes, you're looking at your bank statement while you do it.
Yeah.
That awareness thing is so powerful.
It is. The awareness is what does it. That's what did it for me, being aware of it. And as well as me being aware of it, right? Once you're aware of it, actually taking some action and doing something about it, because a lot of people will not. They know there should be better money. Oh, ignore it. No, try and bury their head inside. No, this is complicated. Just use, excuses. Yes, it is. It can be complicated. I think once you kind of get over the hill, it's like anything in life that's complicated. Driving at first becomes complicated. Passing your exams and GCSE at some point it becomes complicated. So I think it's a very interesting thing. I think that awareness piece is so important, but once you're aware, like you take an action with it. Ian, it's been a great conversation. I feel like we've spoken about a lot, and I really appreciate it. And I know that it's been very valuable for the watchers and listeners. Where can they, people find you if they want to reach out to you?
Social media. Like I'm on social media, on Instagram, ID the Money Man, TikTok the same. I'm on LinkedIn as well. I don't have a website simply because like everything that I do, I share on those channels to help people make better financial decisions. And a lot of the stuff that we talked about is exactly that.
Yeah.
Sharing the information so you can make an impact on your life financially.
Yeah. Amazing. And people, please do go and follow Ian on his channels. He's very consistent. He posts a lot of great content. I really appreciate it. Like I said, it's been such a privilege to sit down with you and just like soak up the wealth of knowledge and, talk about so many different kind of things. And really, I hope that this episode has been helpful for people, especially if you feel like, in terms of that question of overpaying versus investing, it's like Ian said, I think it's about trying to educate yourself, become a bit more confident in the stock market. It's a great wealth building tool. And I do feel like a lot of people are missing out on it. And I would hate for people to be in 20, 30 years, oh my God, I wish I should have started sooner, right? And the other piece of people feeling like it's too late, like Ian said, it's never too late. Do you have any final words for the watchers and listeners?
In terms of your finances, like you're the only person that can have the impact to change this stuff. And it starts with that whole self-awareness piece. But having that North Star in the sky of something to aim towards, it's like you wouldn't get in a taxi and tell the taxi driver, just take me for a drive. Because you need a destination in mind, have the destination in mind. And that awareness piece, it's that old red car scenario. If you went and bought a red BMW tomorrow, how many red BMWs are you going to see? Loads of them.
Yeah.
And it's not because everyone's gone out and bought the same car as you. It's because you're more aware of it. You start to become a little bit more aware, bit by bit, time by time, day by day, and make those small changes. Yeah. And you'll be amazed at what it can drop into place after that.
Amazing. Thank you so much, Ian. Really appreciate you having me on the podcast.
Thank you for having me on.
Thank you so much for tuning into this episode of the podcast. See you next week's episode.